Yeah. Just need to pull up the chat. There we go. Now I got the chat. Well, let me do a reload and then we'll start, huh? Good morning. Good morning. How are you? Yeah, I'm getting used to these copyright music. They called that dubstep. That didn't sound right. This is a little better, huh? All right. All right, we'll just go ahead and pause it. Hey, I got to do something to get copy-free music. YouTube. Anyways, whatever. Good morning. Good morning. How are you doing? Yeah. All right. Well, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Now, why would we want to do that? Well, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money, cannot afford to lose. My name is Wayne. Good to see you. Good morning. Yeah. Good to see you. Very interesting week, huh? Lots going on. Lots going on. All kinds of things going on. So I'm sure we'll be able to keep ourselves busy. One of the big things that I'm thinking about is hedging my retirement account. What am I going to do to hedge? There are so many different options. Very cool. I'm already passively hedged, but I want to be actively actively, I guess, proactively. I don't know. So I got a lot of considerations to go through. If you care about that kind of stuff and you want to know about that thought process, you let me know. Otherwise, we'll just burn through our charts and do that kind of stuff. And if you have questions, let me know. Yeah. So anyways, let me point you to some resources. We all need a little help from sometimes, right? We all need to get by with a little help from our friends kind of thing. Well, Trader's Way is a friend. You should check them out. We all need brokers. Great. This one doesn't trade against you. Cool. Do you like that? They're also faster than most because they're boutique. They don't have 45, 50, 60, 70,000 traders all jammed onto one little MT4 server. So they're just inevitably faster. You get better customer service, that kind of stuff. So look, your Forex trading business is that. It's a business, and you need good service providers, and I recommend Trader's Way. You should check them out. Investor Boot Camp. Oh, I had a link to give you for this. Oh, here it is. Let me find it. Investor Boot Camp. It's $88 a year. I'm also doing a stock trading course. And we did lecture 4 yesterday. If you want a free lecture, 90 minutes long, that's the link. Okay? There's also a secret bonus in there if you want to check that out. Look, obviously I charge money, not a lot in my opinion. Not even the cost of a textbook if you're going to Harvard. It's less than a textbook. But here's the thing. I think you need to know this information. I just honestly believe you need to know this information. Somebody said yesterday, oh, but there's lots of stock trading courses. Yeah, well, this one's the best one in the entire world because it's the only one I've taken. This is my first stock trading course. So I have 20 years of experience and a whole bunch of formal education in finance and economics. This is the way I trade stocks. So I don't know how everybody else does it, but most people are not very good. So anyways, I honestly think you should take it. Okay? Cool. TradePlans.ai. You want some feedback on your technical analysis? This is a free service. Free. And it's fast. It's free and fast and free. And you get feedback on your trading. A second opinion. Cool. But it's private. It doesn't get posted anywhere. We email it to you. So all the feedback's private. I mean, it's just wonderful. Right? So anyways, you should check that out. Again, way better than trading on a demo. Right? What does trading on a demo do for you? Oh, it's practice. Oh, so you get feedback and you get better trading ideas? And you see sort of a second opinion on how maybe you should think about going about your trade plans? You're like, no, I just fire off a trade and maybe it works, maybe it doesn't. Well, how are you supposed to get better? Trade plans is like a demo account. Doesn't cost any money, but put in your trade plan what you think is going to happen. And then, boom, you get another way of looking at it. I mean, you'll get 3 different trade plans based on your trading idea, short-term, medium-term, and long-term. It might just open your eyes on the process of planning trades. A free coach. It's free because he doesn't eat money and doesn't have to pay rent. Well, actually, he pays rent. I have to pay for Amazon Web Services because it sits on the cloud. So it costs me money. It's free for you. I don't know. Maybe I'm stupid. Let me say that again. I've spent thousands of dollars building it. It cost me money to run it. And, not insignificant amounts of money either. Okay? Yeah, of course, Yosef. Okay? And then, so it costs me money. It's free for you. Anyways, and then QuantBox automates your macroeconomic research. You should check all these things out. Okay. Today at Investor Bootcamp, the swing trading group and the day trading group are meeting live. Why did that do that? All right, hang on. Okay, the day trading group and the swing trading group are meeting today. Cool. Love it. All right. Oil is collapsing. That's the biggie. That's the doozy. Zuropa. All right, so what I wanted to do is maybe just go to Zuropa. Zuropa. So funny, huh? Scarves. Everyone has to have a scarf. Anyways, yeah. October 26th, that is my date of birth. All right, no, it's not. The Governing Council today decided to keep the 3 key ECB interest rates unchanged. All right. So how come I didn't cover that live? Because we already knew. We already knew this. How did we know? Because that's what they said in their last meeting. I mean, it's incredible when people miss things like this, huh? So anyways, yeah. Inflation is still expected to stay too high for too long. Okay. Inflation dropped quite a bit in September due to strong base effects. What did that mean? Well, let's cover that for a second. Okay, so let's say you were doing a 5 EMA. Hang on, I got to move this from there. Okay, so you would look at a 5 EMA, and you would add up, let's say the first price is 10, the next price is 11, the next price is 12, the next price is 13, next price is 14. Can you predict the next one? 15. Okay. So you would then add these up and divide it by 5, and you'd get an average price. So as new data comes in, you then add 16 and you drop the base of 10. And then the new one comes in 17, and then you drop the base of 12. Okay, that's the base effect. And it's incredibly important when you have sort of like, if this number here was small, so 2 instead of 12. Let's do it that way. Okay. Then 2 relative to 17 is a significant difference. Or if it was the other way, 12 relative to 7. Okay. The differences are striking. And what you want to do is at some point, so right? At some point, what you want to do is move away from the outline numbers. So let's go back to this. The base effect of moving from 2 over 17 versus 13 over 18, there's a dramatic shift in the average value of that calculation. And that's what they're talking about here in the base effects. They're moving back into normal numbers versus normal numbers versus, a radically low number compared to a high number, okay? Or vice versa, of course. Okay? And so the rate of change changes and flattens, right? The Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. Notice that they memorize these statements and they say them in every speech, in every interview. They'll say it word for word. Jay Powell does his as well. Okay? Based on its current assessment, which might change, is what they're saying, the Governing Council considers that the key ECB interest rates are. Okay? They consider that they are at levels that maintain for long enough, sufficiently long duration, will make a substantial contribution to the goal. This is exactly what they said last meeting. They told us they were done for now. So if anybody is shocked, that means they don't know. But they literally said that the last meeting. They're done. So be careful of those that are surprised by this news because they just have told you that they didn't read the last statement. So one thing we always do at Investor Bootcamp, and now we make it a routine, we read the statements. So for those that are not members of Investor Bootcamp live groups, every Tuesday, we go through the news and we read the actual reports and we read the actual statements. Now, this is homework that you should be doing. But of course, it's always difficult. It takes time. Nobody really wants to download. I mean, just finding the 13 different links or whatever, and then downloading the reports, and then actually reading them, and then actually understanding them, it's a lot of effort. And really, nobody loves downloading economic reports and reading them. But we need to do it if we're professionals. And so now we make it a normal part of our routine every Tuesday, right? We do this together. We do our homework together. Okay? Right? Right. Okay, right on. Yeah. Oh, thank you, Denise. Yeah, I'm always worried about these things. I'm always worried I'm not doing enough. So that feedback makes me happy. Thank you, Denise. It's important that you do the work. And by adding this, it ensures you do the work. And also it shows you how to do the work. So when you become a successful, independently thinking trader and investor, you will know. It's $99 a month, Samuel. That's sessions on Tuesdays and Thursdays. So today we're doing group work. But anyways, Investor Bootcamp, like I was showing you here earlier. So the swing trading group, Tuesdays and Thursdays. Okay. We used to do something called stop, look, and correct sessions, but now I've automated that. I mean, think about how radical it is. So I need to update this. Samuel B, investorbootcamp.com. So we used to on Tuesdays look at your failed technical analysis trades. Okay? You would upload your trade plan and then we would discuss it. I would give you personal feedback. And we would do that once a week. With tradeplans.ai, I've automated the whole process. So you could just upload it now in less than 2 seconds. It's in your email. Feedback on your trade plan on 3 different time frames. I've automated the whole thing. There's 3 different types of AIs working together, all hosted on the Google Cloud. Sorry, Amazon Cloud, sorry. So now we don't need to do that. So now I need to update this. So I'm glad that I brought this up. And we call it the week on the street. And we do the fundamental homework that you really should do as a professional trader, literally going line by line through the actual reports. Okay? Cool. I mean, sweet, right? Yeah. All right. So, yeah. All right, crikey. All right. So, oil till the mum, huh? Till the mum. Oh, my God. Oh, we're in a buy zone. Oh, loufle. Okay, we are in a buy zone. Getting there. Okay, I want to bring this up. I don't want to mess with that because I like that setup. I'm going to move it onto a more traditional chart. And I'm going to go to my WTI. Okay. Beep. And ooh la la, 83 looks good. 81.5 looks good. Interesting. Okay. So we are in zones of which are pretty good. So this 83.23. Then the next one is sort of 82 to 81.5. And then I go back to this one. Okay. And probably on a fiver, on a cinco. They say I sound like a chulo. I'm kind of interested in some of these prices, brah. Okay. Richard says, what all economic news? All of it. Okay. We went through a lot. Anything important, I go through. And the cool thing is, the cool thing about those meetings is you see all the different sort of databases and resources that we access all over the world. China, Japan, Australia, New Zealand, Canada, the United States, all these different government agencies, UK, Euro. We're going into all these different government agencies from all around the world. And we're like, we're like Japan and China, and we're reading their reports from their websites. It's really cool. And I suppose the cool thing is I spent 2 hours gathering the intelligence for you. So you don't have to spend 2 hours just getting the info and then actually having to read it. So I download all the stuff and then we read it together. I mean, I think that's super cool, brah. Sorry, I'm working on my American accent. It's getting pretty good, huh? Yeah. You're going to think I'm American one of these days. All right. So anyways, I'm interested. So I'm going to go back into the Cinco. And I'm going to look for a buy. I'm going to look for a buy. Okay. Let her fall till she stops falling. cool. Samuel B says, yeah, that's cool. I've always liked group work. Yeah, when you're in a class, because remember, I guess it's been a few years now, but I just went through 5 years of university, even as, a gray-haired, beautiful former supermodel. So I'm very in tune to all the things like group work. And when you take a class and you find a TA, whatever you call them, proctors, I don't know the other names that you guys would call them, but every university sort of has a different name. But you have your class, and then you have your class to help prepare you to do the homework, right? And some of these proctors are very, I don't know, sort of cold, where they're like, okay, well, we'll go through all the math from a different point of view. And you're like, oh man, and so you're just learning the same thing from a different point of view. And sometimes it's helpful, sometimes it's not. But then every once in a while, you find someone, a TA, that basically says, let's go through all the homework exercises together. And you're like, oh, snap. They're going to do my homework for me, right? And you're like, yes. So instead of just doing the lecture again, cutting out the fat, just doing the lecture, a no thrills version of it, instead they're like, let's just do our homework together. And you're like, dude, I'm going to get better grades. I don't have to waste an hour and a half with this proctor and then go on to grades, all that kind of stuff. Like, wow, we can do our homework together. And they're basically going to give me the answers and show me how to do it. You're like, yes. Right. Right, Samuel? I'm like, yeah, this is guy. So you end up writing their names down. So later on, when you're picking other classes for the next semester, you look for the well-known names where you're like, oh, I know this proctor. Because look, if you're doing all economics classes or all finance classes, you start to know the professors and you start to know the TAs. And anyways, you're picking and choosing because of the professor, not because of the class and because of the TA. So I totally get that. So anyways, that's what we're doing. I'm doing your homework for you. Zuropa. Ba 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 da da. Zuropa. Ba boo boo boo. Okay, so so a big move on GDP for sure. Okay, but again, we if you follow the fundamentals, like we already know this stuff. I've been talking about good GDP for a couple of weeks, several weeks, maybe longer than that now, right? But anyways, continuing jobless claims, right? 1.8 million. Wow, interesting. 1.79. Because we're going to start to see that increase. So that could be interesting. Let me get off the daily here. Let's go. I'm watching gold, by the way. Okay, and there's the oil. So we have gold and oil. And then really, let me zoom into this one a little bit further. And of course, today needs to be an up day. Let's kind of go. Initial jobless claims 210. Okay, we actually want that to go up a little bit. Teamwork. does that go? Teamwork. I think it's Super Pets. There's an animal in trouble somewhere. Anyways, all right. So just a lot of things to go through. PCE 2.4, durable goods 4.7. So, okay, core PCE down a bit. Interesting. Okay, down actually a fair bit. And durable goods up a fair bit. So it's interesting. People are making less money, but they're buying cars and fridges. Well, the interesting thing is once you buy a fridge, you don't need another one for a while. You take out defense, it's even bigger. Yeah, interesting. It looks like most of it is cars. People are buying cars, huh? Yeah, okay. Durable goods. Looks like most of it is cars and bombs. If you take out bombs that we're sending to the Ukraine, and you take out cars, it's quite flat. Trade balance only 85 billion to the negative. The bigger the negative, the better. And when you get a big negative number, that's negative on the dollar, which is positive. Remember what it's saying. Foreigners are willing to work cheaper than Americans. Okay? Workers at Ford just got a 25% pay hike. Oh, well, that's important because we have 3% inflation. Well, 4% inflation. They're like, well, they didn't get raises during the great financial crisis. Well, they could have been fired, but anyways. So GDP 4.9, smoking red hot. Okay. So pretty good numbers in most of these. Okay, Americans are buying cars and fridges despite making a little less money, but you actually want that right now because we're trying to cool off inflation. Okay, jobless claims up slightly is what you want. You don't want a spike. And of course, what we're trying to do is reduce inflation and reduce wages. So, you know, we're making some headway there. And then 5% GDP, right? We're 4.9. What was the number? 4.9? Yeah. Yeah, that's good, bro. So maybe this gets me out of having to hedge today. Well, I don't know about that, but we will have to pay attention. What time is the press conference? Is it in 6 minutes? I think so, right? Is that right? Stretch. So Dow double bottoming. S&P trying to climb, but boy, does it have a lot of work to do yet. And NASI, wow, in serious trouble. Yeah. Teamwork. Teamwork. I can't remember how the song goes. So I propose we do the press conference. All right, on. Jason, I got your email. If you're here. Uh, all right. So we're working on me being in London this spring. And does anyone want to do a meetup this spring? February or March? You guys want to get together, maybe do a private meeting at the Oxford Club, which is super, super fancy pants. Can't get in unless you're an Oxford man. Or I think they let women in. I don't know. It's London. Yeah. Anyone want to go to an ultra exclusive fancy pants private club in the best part of London, February or March? And then actually a half a block away is one of my two of my favorite cigar bars in London. We could one of them has room, so we could rope off an entire section just for us, and we could have drinks and cigars after our fancy pants meeting at the Oxford Club. Anybody want to do a meetup like that in London? Maybe go to a wicked awesome restaurant as well. London's got quite a few. Anybody? Bueller? No? Yeah? No? I like me in London. Oh, you got some time off? Yeah, that'd be interesting. And by the way, Denise, I've forgotten to follow up in regards to your friend attending the CIA. Yeah, I still have the concern, but let's deal with it. Let's say yes, because I like the idea that, if you know each other, then even outside of the CIA, you can collaborate or discuss, it's supportive to have a friend talk about these complicated matters, right? So I'm like, yeah, I think I can capitulate. It's sort of like, I get it. We should. So, anyways, we should talk about bringing him in. I think I'm okay with that. I'll get over it. Yeah, yeah, but I see benefits as right. I see benefits. Yeah. Right, Richard says that's his problem. I have no friends to talk about trading and investing. Yeah, without a doubt. Or I'm I definitely don't. Although I have friends with money that then trade almost like for fun, like trade for a hobby, and I don't like that either. Right? It's like playing poker with somebody that's playing for fun, not playing to win. It changes things. Ruins the game for me. I don't play poker against my wife because she plays for fun and she doesn't play like by the rules like that I would consider. She's doing it for fun. And it sucks for me because she wins. And I'm like, you can't do that. That's not how you play that hand. She's like, I'm like, ah. Oh, we got it? Yeah, well, I asked you guys if you want to watch it, and nobody responded. So let me bring it back up. Boo. Oh, gold, dang it, son of a. There we go. It's on the home. It's on the home. All right, so who's going to meet up? See, the plan is I'll be speaking at the London School of Economics.
President Lagarde,
we can meet for drinks after.
Mentioned the great Greek poet Cavafy and said that during Ulysses' journey to
Ithaca, the Greeks and their poets.
He showed perseverance and resilience to arrive at his destination, but also he learned a lot during his long journey. He became much wiser. What happened in the last 15 years is well known to all of us. It is now part of our shared common history. What is important is that we are all now wiser, stronger, closer to each other, better prepared to tackle difficulties, and, if I may say so, more European. Thank you. Wolfgang, you have the floor.
Thank you very much, Governor Stournaris. And we are joined here on stage in Athens by President Lagarde and Vice President Egindos. My name is Wolfgang Kreusel. We have participants via WebEx, via online, and if you ask questions, please turn on your camera and the microphone. And with that, I hand over to President Lagarde, please.
Thank you and good afternoon to all of you. The Vice President and I welcome you to our press conference, and I would like to begin by thanking Governor Stournaris for his kind hospitality and express our special gratitude to his staff for the excellent organization of today's meeting of the Governing Council. The Governing Council today decided to keep the 3 key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long.
No pearls, huh?
And domestic price pressures
no
remain
scarf?
strong. At the same time, inflation dropped markedly in September, including due to strong base effects, and most measures of underlying inflation have continued to ease.
Oh, great. She's reading the report for us.
Interest rate increases continue to be transmitted forcefully into financing conditions. This is increasingly dampening demand and thereby helps push down inflation. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that the key ECB interest rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data. In particular, our interest rate decisions will be based on our assessment and the strength of monetary policy transmission. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions.
Oh, snap. Look at that.
The euro area economy remains weak. Recent information suggests that manufacturing output has continued to fall. Subdued foreign demand and tighter financing conditions are increasingly weighing on investment and consumer spending. The services sector is also weakening further. This is mainly because weaker industrial activity is spilling over to other sectors, the impetus from reopening effects is fading, and the impact of higher interest rates is broadening. The economy is likely to remain weak for the remainder of this year. But as inflation falls further, household real incomes
Wow, look at
recover, and the demand for euro
Kick off the
area
M1.
exports
Get
picks
up there.
the economy should strengthen over the coming years. Economic activity has so far been supported by the strength of the labor market. The unemployment rate stood at a historical low of 6.4% in August. At the same time, there are signs that the labor market is driving up medium-term inflationary pressures, which would otherwise call for even tighter monetary policy. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Structural reforms and investments to enhance the euro area's supply capacity, which would be supported by the full implementation of the Next Generation EU programme, can help reduce price pressures in the medium term while supporting the green and digital transition. To that end, the reform of the EU's economic governance framework should be concluded before the end of this year, and progress towards capital market union and the completion of banking union should be accelerated. Turning to inflation. Inflation dropped to 4.3% in September, almost a full percentage point lower than its August level. In the near term, it is likely
That is
to
pretty
come
good.
down
That's a big
further
drop, huh?
as the sharp price increases in energy and food recorded in autumn 2022 will drop out of the yearly rates. September's decline was broad-based. Food price inflation slowed again, although it remains high by historical standards. In annual terms, energy prices fell by 4.6%, but most recently have risen again and become less predictable in view of the new geopolitical tensions. Inflation, excluding energy and food, dropped to 4.5% in September from 5.3% in August. This fall
So
was
we, of course,
supported
have
by
read all of
improving
this.
supply conditions, the pass-through of previous declines in energy prices, and the impact of tighter monetary policy on demand.
I'm disappointed
and
she's
corporate
not wearing a
pricing
scarf or
power.
pearls. I find it rude.
Goods and services inflation rates fell substantially to 4.1% and 4.7% respectively, with services inflation also being pulled down by pronounced base effects. Price pressures in tourism and travel appear to be moderating. Most measures of underlying inflation continue to decline. At the same time, domestic price pressures are still strong, reflecting also the growing importance of rising wages. Measures of longer-term inflation expectations mostly stand around 2%. Nonetheless, some indicators remain elevated and need to be monitored closely.
Yeah, they
Let's
do.
turn to the risk assessment. The risks to economic growth remain tilted to the downside. Growth could be lower if effects of monetary policy turn out stronger than expected. A weaker world economy would also weigh on growth. Russia's unjustified war against Ukraine and the tragic conflict triggered by the terrorist attacks on Israel are key sources of geopolitical risk. This may result in firms and households becoming less confident, and more uncertain about the future and dampen growth further. Conversely, growth could be higher than expected if the still resilient labor market and rising real incomes mean that people and businesses become more confident and spend more, or the world economy grows more strongly than expected. Upside risks to inflation could come from higher energy and food costs. The heightened geopolitical tensions could drive up energy prices in the near term, while making the medium-term outlook more uncertain. Extreme weather and the unfolding climate crisis more broadly
You're missing the
could
action.
push food prices up by more than expected. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation.
It's a pretty exciting
higher,
video.
including over the medium term. By contrast, weaker demand, for example, owing to a stronger transmission of monetary policy or a worsening of the economic environment in the rest of the world amid greater geopolitical risks, would ease price pressures, especially over the medium term. Looking at the financial and monetary conditions now. Longer-term interest rates have risen markedly since our last meeting, reflecting strong
It's terrible that it's
increases
just
in other
the statement
major
that
economies.
everyone has already read. Like,
Our monetary
why can't we
policy
just skip
continues
this?
to transmit strongly into broader financing conditions. Funding has become more expensive for banks, and interest rates for business loans and mortgages
People get
rose again in
into
August
their traditions,
to
right?
5% and 3.9%
Well, we've always just read it
respectively.
again. Well, we've already read it.
Higher borrowing rate, with the associated cuts in investment plans and house purchases, led to a further sharp drop in credit demand in the third quarter, as reported in our latest bank lending survey. Moreover, credit standards for loans to firms and households tightened further. Banks are becoming more concerned about the risks faced by their customers and are less willing to take on risks themselves. Against this background, credit dynamics have weakened further. The annual growth rate of loans to firms has dropped sharply from 2.2%
So
in
that
July
shows
to
that their
0.7%
actions as the
in August
ECB are
and 0.2%
starting to
in
work.
September. Loans to households remain subdued, with the growth rate slowing to 1% in August and 0.8% in September. Amid weak lending and the reduction in the Eurosystem balance sheet, the annual growth rate of M3 fell to minus 1.3% in August, lowest level recorded since the start of the euro, and still stood at minus 1.2% in September. So, in conclusion, the
Yay!
Governing Council today decided to keep the three key ECB interest rates unchanged.
Yeah, we knew that 3 months
The
ago.
incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. At the same time, inflation dropped markedly in September, including due to strong base effects, and most measures of underlying inflation have continued to ease. Our past interest rate increases continue to be transmitted forcefully into financing conditions. This is increasingly dampening demand and thereby helps push down inflation. We are determined to ensure that inflation returns to our 2% medium-term targets in a timely manner. Based on our current assessment, we consider that rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB rates will be set at sufficiently restrictive levels for as long as necessary to ensure such a timely return. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Lefteris Papadimos of Reuters. Lefteris, please.
Hi. President Lagarde, what role did the recent weak economic data...
I mean, the sound is so horrible.
Discussion? And secondly, did you discuss or at least begin talking about ending PPP reinvestment?
Like, come on, Greece. Gee whiz.
Thank you very much. And let me take the opportunity of this first question to really express our appreciation for the extraordinary hospitality that the Greek National Bank, but also the Greek people that we have met here and there, have really deployed on the occasion of this visit. It has been a stellar organization and a tribute to the capacity of Greece in general to organize things and to make us feel welcome. So, Ekaristo. You ask me, I will start with your two last questions because in a way they are the most easy ones. Neither of these two questions, nor the PEP, nor the remuneration of required reserve, have been discussed at this meeting. You ask me about the current geopolitical environment and how that has weighed on our decision. I think we repeat 2 or 3 times in the context of this monetary policy statement the risks posed by the geopolitical environment and these aggravated risks as we see them unfold and develop. And of course, you have a special sentence in the MPS that refers specifically, in addition to the totally unjustified war of Russia against Ukraine, which refers to the tragic development as a result of the terrorist attack on Israel. We are monitoring the situation. We are very attentive to the economic consequences that that could have, whether in terms of direct or indirect impact on energy prices or the level of confidence that economic actors will continue to display. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you, Madame Lagarde. I have 2 questions. I think on many people's mind is the question, how long is actually sufficiently long, and what will make you rethink and perhaps cut rates at one point in time? Is it at 2% inflation? Is it at 2.5? Is it at 3? I think that is something the market is interested in. And then my second question goes on your comments about the yields, which are on the rise as well in the euro area, and you said from other jurisdictions or from other regions, you're probably referring to the United States. So are you concerned about that rise in yields as well, and also about the potential fragmentation here?
Oh, finally. Thank you.
Thank you very much for your 3 questions, if I counted right. Huh? So how long is sufficiently long?
She laughs in the beginning.
We refer to timely manner, sufficiently long. But in the same breath, I say we shall be data dependent. And at this point of our fight against inflation, and after 10 successive hikes, now is not the time for forward guidance. Now is the time to really stick to our data dependency knitting, if I may say. And we shall do so. We have acknowledged on the occasion of this meeting that our assessment is confirmed, the assessment that we had in September. All numbers, if anything, have reinforced our assessment of the situation. We have applied the 3 criteria that you all know well, the inflation outlook, duly informed by any information that we have, the underlying inflation in all its compositions, and the strength of the transmission of monetary policy. So we will continue to be data dependent. Your second question was essentially when and at what level do you cut? This was not discussed at all. And the debate would be absolutely premature.
We didn't even talk about cutting. Love it.
You know, we have acknowledged in our review of the macroeconomic situation back in September and yet again this time around, and we all know, and you know, that labor cost, wages, profit units, the analysis of that is critically important to determine the inflation outlook. And we will continue to accumulate data. On labor, for instance, we are going to have a wealth of numbers and data and intelligence when collective bargaining agreement and annual negotiations in 24 will be completed. That is way into 24. That's only a for instance. And, you know, even having a discussion on cut is totally premature. For the moment, what we're saying is that we have to be steady.
So are you saying it's premature?
This is the decision of today. We are holding. Okay, so your third question had to do with this sort of external tightening, which is not directly relevant to the fundamentals of the euro area economy, but which are tightening element nonetheless, because they directly impact on how long-term yields and long-term rates as well. So that definitely is a spillover that we take into account, and that is compounded with other elements that clearly are bringing inflation down.
Thank you, President Lagarde. And the next question goes to Alex Weber of Bloomberg News. Alex, please.
Good afternoon. Thank you for taking my question. You said that you're seeing strong transmission of your past rate increases to financing conditions. Can you say how much of the impact has yet to hit the real economy and then on inflation? And then secondly, a follow-up on energy costs. I'm trying to understand how you would react to another spike in energy costs for example, as a result of conflict in the Middle East. Would you take the recent inflation episode as a lesson and immediately react to that, or could you afford to wait for second round effects?
Thank you. Those are interesting questions. I'll start with your second one, which is essentially, have we learned anything from the last energy crisis, the impact it has on inflation directly and indirectly, and would we apply the same approach? This is work that is ongoing and that we will continue to do. But it's clear to us that it applies to a completely different economy today, and an economy which has had an episode of very high inflation, an economy where the interest rates is at a very high level of 4%, and an economy that has strong employment and which is weakening. So we have to take all these factors into account to see how possible higher cost of energy would actually affect both GDP and inflation. And it's in the context of that assessment that we would respond accordingly. But be under no doubt, our determination is intact, and our determination to bring inflation to 2% in the medium term is absolutely the same, if not reinforced by the proximity of the destination. Your first question was the...
I hate that when somebody asks what your first question is, and you're like, I don't remember.
What we are seeing is a very strong transmission of our monetary policy in the banking sector in particular. And the financing of the economy as a result is directly affected, which in turn plays onto the reduction of inflation and the dampening of demand. And those numbers are really, you have seen the bank lending survey, I'm sure, and they are very striking in terms of both volume and rate transmission. We know that there is still more to come. So as is often the case with monetary policy, there is this transmission lag time. The assessment by our staff is that there is still more in the pipeline and more to come to affect the real economy. And the assumption is that it will continue to unfold throughout the end of 23 and first quarter of 24. Now, one might argue that it's going to last longer, but we have already seen a significant transmission to the financing conditions. More is to come. And if you look at, for instance, the housing sector, it's pretty obvious that there is transmission to the real economy. If you look at the volume of capital expenditure, of investment by corporates, there is a reduction. It's not just the banks telling us that they will be more attentive to the risk and that they are reducing their flow of credit. It's also the corporates that are putting a brake on their investment because of the level of interest rates. That clearly results from the various corporate telephone surveys that we conduct and from the bank lending survey as well. So both in the housing sector and in the investment numbers that we have, it is transmitting to the real economy.
Thank you. And the next question goes to Eleftheria Kotali of the Greek website Capital GR.
Hello. President Lagarde, I would like to ask you a question on spread widening. Have you at all discussed spread widening, and especially the case of Italy? Italian spreads are now above 200 basis points, and I was wondering if this is a level the ECB is comfortable with, or it is considered to be a level of significant widening. And my second question is on Greece. Are Greek bonds now back to the ECB's normality? That is, are they now eligible for every purchase program when and if they are ever activated again? And are you confident that the Greek economy can return to normality? That is, where it was before the debt crisis, when it was rated A and A+ even? Thank you.
Thank you very much for your question. Your two questions. Let me turn to Greece first and remind you that we only have one active purchase program that is operating at the moment, and that's the reinvestments that we conduct under the PEP. Under APP, we don't do any reinvestment anymore, so there is no question as to which country is eligible or not eligible. So Greece was eligible to PEP under a special waiver that had been decided at the time. Well, the good news is that the waiver is irrelevant. Greece does not need any waiver. The Greek instruments are eligible to PEP without any exceptions. So that's point number one. Point number two, Greece is now back to pre-COVID situation, and I speak under the control of my colleague and friend, Governor Stournaras, but Greece is actually higher than the level where it was just pre-COVID. And if I can, comparisons are odious, but I will make an exception. Greece compares extremely well with other countries. And I'm saying that because we're in Greece. I'm not going to, comment any further on who is better, because I don't want to comment on country-specific situation. I'll look at euro area numbers, but we are here in Greece. And Greece has demonstrated phenomenal recovery capacity, and it is, if I recall, 10% above the pre-COVID level at this point in time now. So I don't know what is normal or abnormal, but I have to say that it's a stellar performance. Would you like to add to this? And then I'll come back to your first question.
I fully agree, President, with what you have said. on activity, we're about 10% higher than the pre-COVID situation. The GDP growth is much higher than the average of the Eurozone. Spreads, they are within a range which we think it is quite normal. So all in all, it's a success story, as the President said in her press conference. But also, I do not deny that still there's a lot
I no
to
deny.
be done until we get back to a rating of A+, as you said.
So on the first part of your intervention, let me remind you what we do. Our mission is price stability. We have defined it in our strategy review as 2%. We are not at 2%. The best tools that we can use to return inflation to 2% are our interest rates. And this is what we are using, and I just want to mention that the fact that we are holding doesn't mean to say that we will never hike again, okay? So at this point in time, on the basis of the data that we have, we are confident that the rates at 4%, well, I should say, the 3 rates at the level they are contribute substantially to bringing us back to 2% in a timely manner. But we are data dependent. Second point is that in addition to our stance,
Okay, it's time for another trade plan.
we also
review.
have to make sure that there is proper transmission of our monetary policy throughout the whole euro area and to all countries in the euro area. And we have all the adequate tools in order to make sure that that happens. Thank you.
I like that. Thank you.
Thank you very much. President Lagarde, two questions from me. The first question is about central bank losses. So we've seen this week that the Riksbank, I know Sweden's not in the Eurozone, but the Riksbank has warned it will need 80 billion Swedish krona from the government to repair its balance sheet. Do you expect any Eurozone central banks to need similar kinds of capital injections? And the second one I'd like to ask is about PEP reinvestments. What's your view on the various calls we've heard from members of your governing council to say that those could be, the end of those reinvestments could be brought forward? Do you think that would be a risky move? Thank you.
Thank you very much for your 2 questions. So on the first question,
She's funny today, huh?
I will not go into the specifics of each and every national central banks because they are all in a different situation. Some of them are publicly quoted institutions, others are not, and there is no one-size-fits-all for the situation they're in. What I know is that as a Eurosystem and as ECB, we have one mission, which is price stability. And we do not have as a purpose to show profits or to cover losses. And it would be actually wrong if our decisions were guided by our P&L accounts rather than for pure monetary policy purposes in order to bring inflation back to 2% in the medium term. On your second point, as I said earlier, we have not discussed PEP on the occasion of this meeting. Thank you.
Thank you very much. And the next question goes to Silvia Berzoni of the Italian TV program Class CNBC. Silvia, please.
Good afternoon to all, President. Do you think that given the vigor of the monetary policy transmission and the added uncertainty of the war between Hamas and Israel that you just mentioned, ECB economic forecast might be a little too optimistic? Thank you very much.
Well, thank you so much for your question. I'm tempted to give you an appointment for our next monetary policy meeting because obviously in December we will have a whole range of new projections, new numbers, and as is often the case, we revisit either up or down, depending on the situation. And once again, we're going to be purely data dependent. What we know for a fact is that growth has weakened. And if we look at PMI numbers, for instance, they are not indicative of a very vigorous growth, which is why I have clearly indicated in the monetary policy statement that growth continues to be weak.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. Just again, coming back on the bank lending survey, what you mentioned several times, the economy basically stagnates. I mean, is there a risk, are you worried that you've just been too far? Yes, the transmission will be slow, but you might have gone too far. And that's just one question, actually.
Yeah, it is one question.
Sorry.
No, that's okay. Well, I can only repeat what we say, and we actually repeat in the monetary policy statement, which is that we believe that the three rates where they are, if kept for a sufficiently long period of time, will actually make the contribution that is needed, the substantial contribution that is needed to return inflation to 2% in the medium term. And what we did on the occasion of this monetary policy meeting was to compare the September that we had in September when we made our decision, the new data that came in, including the inflation number, headline, and core inflation, including the bank lending survey, notably, and the various flash estimates and PMI numbers to confirm the assessment that we had previously. And let's not forget, our mission is to return inflation to 2%, to make sure that inflation does not cut into purchasing power of people.
Thank you. And the next question goes to Leonidas Exotsidis of Handelsblatt here. Leonidas, please.
Good afternoon, thank you. I would like to come back to the rising bond yields again, please. There is the point of view that the rise in the bond yields helps the central bank in the transmission of the monetary policy as financial conditions become more tightened. On the other hand, there are also people arguing that it can become a risk for the financial stability. Do you agree with both points of view? And do you think it can become more difficult for you to find the right balance in the future? Thank you.
Thank you. I'm going to share your question with the Vice President because he's the real expert on this panel on financial stability. But I just want to, again, remind you of what I said about the rising bond yields. This is a movement that originated outside the euro area. It is not directly related to the fundamentals of the euro area, and it is different, but we are facing the same
it should be nearly real time, your customer.
Feared, back
although
in March,
YouTube often has a delay.
The various regional banks and Silicon Valley banks and Signature and First Republic collapses, where again there was spillover and the fear of more of it. But this is something that clearly impacts our own rates, and we take that into account.
Good afternoon, everyone. Well, in a couple of weeks, we are going to release our financial stability review. The financial stability review, is the document where we indicate the main financial stability risks that we have here in the euro area. And I would say that the increases in yields is something that we are looking at very carefully. Why? Because the main risk that we have identified in the past and that they could continue being identified in the near future is very high valuations of different kind of assets. And we have seen that when you look at these valuations, not only financial assets, as the president indicated before, we refer as well to the real estate market. Well, the increase in yields can give rise to an important correction. So this is something that we are taking into consideration very, very closely. And simultaneously, other factors that, the higher yields can have an impact, mainly on the non-bank financial intermediaries. There we have seen that there is a concentration of potential vulnerabilities in terms of liquidity risks or liquidity mismatches, in terms of credit risk. And this kind of situations that you have an important and pervasive increase in yields can give rise to additional problems for this part of the financial system. That is not totally isolated from the rest of the financial system. It has important liaisons and links with the banks. So the increase in yields is something that we are considering very closely, and we will make a lot of comments with respect, in our financial stability review about the potential impact that this might have in terms of financial stability.
If you're a day trader...
Thank you, Vice President. The next question goes to Michalis Psilos of the Greek Daily.
So that's what we're doing in here, intraday, actually. So I'm switching between 4 hour and 5.
Eligible, as you said. Would they be included in your APP portfolio? Should you pose QT?
Enzo, it should run to target.
That's for sure. And the second question, once upon a time, I would like to say
what you're telling me is you don't know your target.
Saving was very important, but in most euro area, like in Greece, deposit rates are almost zero, and of course well below from inflation, while lending rates have increased considerably. How do you comment on that? What can be done to change this situation? Thank you.
Okay, this market is bearish.
Thank you very much for your two questions. On the first one, I'm tempted to tell you that I don't want to deal with hypotheticals. We are in
we've hit target already, so this is a counter trend.
Of bringing it to 2% using predominantly the interest rates and ancillary additional component that come as a complement, such as the gradual reduction of the balance sheet, as we have seen as a result of TLTRO reimbursement, as a result of non-reinvestment of APP. But I'm not going to, have hypotheticals about what if after tightening, blah, blah. Suffice to say that Greece is today eligible to the PEP without any waiver. So it's, pari passu. Everyone in the group, the 20 member states, are in the same situation from that perspective. You asked me about the rates and the obvious gap between the lending rates by banks to corporates and to households and the remuneration of deposits. Our job at the ECB and at national central banks is to set the rates at which banks and other institutions finance themselves. Our job is not to set the rates at which they lend. We hope that they transmit that properly because that's part of the transmission mechanism, nor the rate at which they remunerate deposits. And this is an issue that occurs in several euro area countries, to which solutions are brought by either the authorities or by the power of consumers themselves or by the competition authorities. But this is not an area where the ECB or the National Central Bank can actually take action.
Next question, Andres Stumpf of the Spanish daily Expansión. Here.
Thank you. Madam President, you're a few days away from finishing your first half.
What a terrible place to host a conference, huh?
I'm wondering if there's anything you regret from these 4 years, and also if there's anything that makes you or have made you especially proud. And a second question, if I may. In Spain, the political parties are trying to form government, have proposed extending the new extraordinary bank taxes. And when the tax was announced, the ECB published an opinion advising against it. Should we expect another opinion, or have you got anything to say about this topic?
It's not wrong, but it doesn't seem right the way it was explained.
Thank you for your personal question, and rest assured that I have no regret, okay? I'm not going to sing it to you, but there is a famous French singer that has done that much better than I could ever do it. So no regret.
Edith Piaf, is that right?
You know what happened today? one of our members, after 12 years of loyal and good services, finished his term on the Governing Council, and it was his farewell Governing Council meeting. The level of warmth, of emotion, of acknowledgement that was demonstrated to him.
It's good to know these things, right, JGB?
You know, reminded all of us around the table that sometimes we disagree. By the way, we had a unanimous decision on this occasion, just in case any of you is interested. Thank you. So while we disagree on occasions, because there is this common drive for delivering on the mission, we have a quality of debates, of exchanges, of different views. We try to convince each other on occasions, and we sometimes manage. That is something that is to be cherished. And in a world where, for dissenting opinions, people go into totally unconsensual and rational
So anyways, Anza, it's hard to talk over the press conference.
A gem. So that's for my personal take. I will not get personal again. That was it. So on the tax, maybe my Vice President.
Our assessment about bank taxes is well known. We have always said that this kind of levies, this kind of taxes should not impair lending, should not impair credit growth, and should not damage the solvency of the banks. And that was the recipe that included in our opinions for taxes that were approved in the case of Lithuania, Spain, and Italy. Well, in the case of Italy, we had different versions, no? And the final one, I have to say that it was more reasonable, no, in that terms, because they indicated that if they increase the capital buffers, then the tax will be reduced. So this is the approach. So I don't know whether what's going to happen, with the Spanish case, whether it's going to be extended or not. So let's see. But the principles of our assessment with respect to this kind of taxation is quite clear.
Thank you, Vice President. And the last question today goes to Klaus Rainer Jakisch of ARD Television. Klaus Rainer, please.
Good afternoon. Thank you very much for taking my questions. Mrs. President, some people speculate that we've seen the height or the peak of the current interest cycle. Can we interpret this from today's decision?
Sorry, the peak of what?
Of the interest cycles. Can we interpret this from today's meeting, or is still everything open? And the second question you have already answered partly. Can you give us a little bit of insight of the debate today? From the protocols of last meeting, one can get a bit the impression that the differences between the different groups of the Governing Council may have perhaps be a bit stronger than in the past. Is this interpretation right? Thank you.
Typically when you reach by unanimous consent a decision, you don't have a widening of the differences. And, together with colleagues who have been participating in all these hours of discussions here in Athens, I can assure you that there was a general, well-shared assessment of the current situation, the judgment that we have made, and the monetary policy decision that we took, which after 10 different hikes over the last 15 months is for the first time a hold. So it's, sometimes inaction is action, and a decision to hold
being in cash is a position,
and was taken by total agreement of all governors and members of the Governing Council this morning. So if any of you wanted to add to that, but I think you have either a misinterpretation or strange information from inside our discussion. We were inside the rooms, and I can assure you that it was strong. Do you want to add something, Yanis?
No, I fully agree with what you said. It was a unanimous decision.
And as to your question on peak, I'm not going to pass a judgment to say that we are at peak. We are data dependent. And we are going to, meeting after meeting after meeting, assess on the basis of the three criteria of the inflation outlook, of the underlying inflation, and the strength of our monetary policy transmission, whether or not our interest rates are delivering sufficiently in order to help us reach the 2% medium-term inflation. Thank you very much.
Thank you. That's all for today from Athens. Next time is the 14th of December in Frankfurt. Until then, all the best and good afternoon.
And enjoy Athens as you're here.
All right. Well, sort of. Okay, so nothing really terribly new there. Looks like we can get, what, a dozen people together in London. So we're going to go for cocktails, maybe dinner in London this spring. Sounds nice. Remember, if you're incorporated, that'd be a tax write-off. So anywho, haven't learned anything new from the ECB. They're pausing.
Where will the future of computing start?
The quantum
Hang
revolution,
on.
supercomputing.
Let me figure out what I gotta
The
kill.
solutions are countless.
The impacts are endless.
But the
There we go. So, continue mission. So far, it moved up during the press conference. Now, of course, now is the capitulation, or let's say profit taking. And we'll see what happens next. I'm on a 1 minute for this S&P 500, and I really, really, really want it to go up. But I know right now, technically, that's quite doubtful. And all we've done is worked our way up to this level, and it's holding. So I have serious doubts. I might actually have to enter the market and put in a short here. So that's kind of my big thought of the day. Am I going to short to hedge, or should I buy the 10-year T-note, the yield being at 5% again? Okay, in fact, 10-year note yield. And okay. It's up 10% for the month, which means the bond market's been falling. Do I want to lock that in? Yeah, that's a great question. That's what I'll be working on today. As a reminder to everybody that's a member of investorbootcamp.com, the live groups are meeting. All the live groups are meeting for swing trading. It'd be great to do some group work. So it'd be nice to see you there with microphones and cameras. Yes, the advanced technology of bring a laptop, bro. Okay, so it'd be good to see you there and have our group discussions. So anyways, there's our little bit of volatility, and technically this is still down. Technically, if that falls, then you would expect dollar to be strong, that kind of stuff. What we've been sort of watching today is S&P 500. You want to be watching my WTI. There might be a buy there. And you might be, or you should be watching gold for the counter trend setup. As you probably know, double top at 2000 at R2. Okay, not a boring day. But again, big decisions need to be made, so I'll have to put my big girl panties on and do the best I can. Peace on earth. May the pips be with you. May our profits be above average. Thank you for being a subscriber. Thank you for contributing to the awesomeness of Forex.Today. And I will see you soon, huh? Yeah. So I hope to see you at the swing trading group. Let me know if you're going to be there. Yeah, you're going to be there? Who's going to be at the swing trading group meeting this afternoon? Right on? Richard wants to do 20-year, maybe. JP's going to be there. Right on. Denise, awesome. JGB, yep, awesome. Good, good, good. Well, I'll put out cookies and coffee. So, peace on earth, may the pips be with you, may our profits be above average. That just happened.